Thank you.
Okay, so we are going to pick from where we stopped last class. We are still on the lot size calculation. So I think we stop at the mini lot size, right?
Yes.
So we are going to pick from the micro lot size, which is the last type of lot size that we have, the micro lot size. So
Alright.
from what we have on our slide, can you see my screen?
Yes.
All right. So from what you have on our slide here, the minimum lot size when it comes to the micro lot is 0.01. 0.01. The same way we've calculated for standard lots and mini lots is the same way we are using for the micro lots as well. There's no exception to this. It's just only one way. Okay, so it's just only one way. So let's start with the micro. We have 0.01. This is the lowest. And if you look at this from the mini also starts from 0, but after the decimal point the mini starts with 1, but here the micro is starting with 0, which means that for you to be able to identify the micro lot size, after the decimal point we are going to have 0 before we have any particular number. So we have 0.02, 0.03, up to, this is the highest when it's come to the micro lots, we have the 0.09. So this is the lowest and this is the highest. 0.01 is the minimum and 0.09 is the maximum lot size that we have under the micro lots. So we still have 0.04, 0.05, 0.06, 7, 8, and we have the 9, 0.09. So same way, if you want to know the value of dollar for 1 pip, you also, let's say we pick this, which is 0.02. For you to know the value of 1 pip, what are we going to do? We multiply it by 10. We multiply that by 10. So let's bring in our calculator to bring on our calculator. So we have 0.02 multiply by 10, we have 0.2. So the dollar value here is 0.2, still the same thing as 0.20 dollar. You can see that now this one is not even up to $1. This is 20 cents. Just as in naira we have kobo, so in dollar we have
Yeah.
cent. This is 20 cents, not up to $1. So every pip movement, when we are using a micro lot of 0.02, it means market is going to be moving each pip by 20 cents. 20 cents. So now let's say we want to take a trade and we have our stop loss at 30 pips. We have our stop loss at 30 pips and we have our take profits at 120 pips. If we have this, so we still do that same calculation, we already know that a pip movement is 20 cents, then we multiply that by 30 pips. So what we are looking to risk on this trade with a lot size of 0.02 is just $6. $6. And if we are targeting 120 pips, it means 0.20 multiplied by 120 pips. That is, we are looking to make $24. So this micro lot size is good for someone who have a small account size. You can see that even when you have a $50 account or $100 account, you can still trade. And if you want to trade multiple of times before you eventually blow up that account, then you want to consider trading with a micro lot size. If you should have uh, a small amount and you are using the standard lot size, you can see that that is a wrong lot size to use for that account. That is a totally wrong lot size. You are looking to double what you have, but that is not how to trade. That is not how to trade. Trading, you have to think long term. You don't just want to look at how can I trade my $50 to $200 in the next 2 days. If you think like that, you are most likely to lose that $50. But is it possible to do that? Yes, it is possible, but it's not a realistic way to trading. It's not a realistic way to trading. So if you have a smaller account size, you also want to use smaller lot size. So now when you now have a bigger account size, when you start scaling up, you're getting access to big account size, that is when you can now look to use a bigger lot size. And also the lot size, do you have question?
No, no, no.
O-
Okay.
okay. And also the lot size you want to use, you also need to calculate your risks very well before getting on the trade. You want to know what you are risking. You already prepare for a trade, you already know where to put your stop loss, so calculate the lot size to use in line with the amount you are willing to risk on that trade. When you want to prepare yourself for a trade, you are not just looking at, okay, I'm looking to make so amount on this trade. What you should be thinking is that this is the amount I'm willing to risk on that trade. Then you have to calculate your lot size that conform to the amount you are willing to risk. If it is too higher, if it is too high, that means you have to lower your lot size. Do you understand? So I told you that we also have a tools that will help us to calculate a particular lot size. So this is just the manual way we calculate. This is the manual way we calculate lot size. So let me show you the tools we'll be using on the long run, though you are yet to need that, but let me just show you, and when we get to that stage again, you still learn about it again. So it's actually a website, and the website is cashbackforex.com. cashbackforex.com. So when you come on their chart, you just come to tools. Then after these tools, you come down to position size and risk calculator. Position size and risk calculator. So what these platforms helps you to do is that it helps you to generate the proper lot size to use on the trade. So it only asks you some few questions, you input that, it asks you some few information rather, and you input that, then it's going to generate the particular lot size for you. There are times whereby you want to get in on a trade and you start using the manual way. Let's say maybe you want to risk $20 and you just manually calculate for 0.05, and you see that 0.05 is too higher. You try 0.04, you see that it's too higher. While you are still doing this, the market is already moving. The market is not waiting. The market is moving already. So that is why we have to leverage on this platform. So when you now click on that tools and click on position size and calculator, it brings you to this interface, and you can see it's asking you instrument. The instrument is what do you want to trade, what currency pair do you want to trade. So let's say for example this is the chart of gold, and let's say we are looking to buy I said gold, GBP USD. This is the chart of GBP USD, and we place our stop loss here, we put our take profit up here. Now you can see that this stop loss, now how many pips is this, so that I'll know that you've not forgetting what we've talked about. How many pips is that?
40.
Yeah, 40 pips. And how about here?
8.
Yeah, 88. But when inputting on the website, we actually don't need the profit target. What we need is the risk side, which is our stop loss is 40 pips. So let's come back here. The instrument we want to trade is GBP USD. So you click on this arrow and you search GBP USD. You type GBP USD. So this is GBP USD. You click on it and it puts that on here, and now it's asking us stop loss and put in bracket pips. So the information we need to put here is that how many pips is our stop loss from the point we want to enter that trade, and we have our tools that have already shown that to us that it is 40 pips. So we input 40, and here now is another information asking us what is our account balance, what do we have in our accounts. So let's say we have a small trading account, we have $200. $200 is what we have in our trading account. This information you don't need it, just leave it. Now risk here, the only thing you want to input is this instrument, the stop loss, and the account balance, or the deposit currency too. If your deposit currency maybe is in another currency, maybe you deposited in Australian dollar, maybe you deposited with pounds, maybe probably you don't open a US dollar account, but we are actually going to be opening a US dollar account. So risk now is that from this your $200 balance, how much are you willing to risk on this trade? So if what you are willing to risk on that trade, let's say for example you only want to risk $20, you can see this is USD. This USD can be changed to percentage. We have USD and percentage. If you put it on percentage, it means that you want to risk 20% of 200, but for better calculation purposes just change this to USD so you won't get yourself confused, because when you are trying to convert a particular value to percentage you might not get it right. That is if you know how to calculate that so well, no problem about that. But it's just better you just put at USD, you know that okay, this is the value of amount I want to risk. I only want to risk $20 on that trade, and then you scroll down and press on calculate. So when you press on calculate here, it's going to pop out three different information. We have lot, which is the trade size, we have unit, which is the trade size, we have percent at risk. So the lot here is the lot size we are to use on that trade. So now it's telling us to use 0.05 lot size. 0.05 lot size. That is what the calculator is telling us to use. So this one already saves us the stress of calculating it manually before we get the answer. Market is already gone. So here we just come and input small information, and we already get this information. We get this answer. So this is what we actually need here. 0.05. Then we now go to our trading platform to go and place our trade. We know the stop loss already, and then we just put on our trade. So this one helps us to know the right lot size to use on a trade. It helps us to know the right lot size to use on a trade. So with this, we would not be risking too much. We will not be risking too much on a trade. Imagine we just press 0.15 and we just set our stop loss, whereas we don't even know what we are risking. We only know that okay, our stop loss is placed at 40 pips, but we don't know the amount we are risking. That is totally wrong. You should know what you are risking, so if at all the trade goes the other way around, you're already prepared for that. Not that the trade goes against you and then you are seeing something you don't prepared for. So we said we want to risk 20, and then at the end of the day, when the trade fails to go in our direction, we are losing more than 20. Let's say we are losing around 35. Because we are not prepared for that, we will get we will get we will be emotional. We will be emotional because we've lose more than what we actually intended to risk. So that is the tools you use when you want to know the lot size to use. So that is that on lot size. So now let's move further to what we have next. Or do you have any question at all?
No, no, no.
No question. Okay, let's move. All right, so we want to look at trading order. Trading order is splitted into two. These are where you want to enter the market. We have the market order and we have the pending order. The market order is an order to instantly trade at a particular current price. So the way we have the chart of GBP USD, and if our decision is we want to execute that decision now, that is called market order. We want to buy at the market price. Another better example of that is that when you go to the market to buy any particular product, maybe foodstuff or anything, and they call it for you that okay, this product you want to buy, they are selling it for 5,000 naira, and then you just pay for that amount. It means that you buy it at the market price, the amount they are selling it, that is what you bought it. You don't price down, you don't negotiate, you just buy it at that price. That is market order, or you can also call it instant execution. Instant execution or market order, that is buying at the current market price or selling at the current market price. That is market order. And then we have the other one, which is pending order. This is now an order that allows our trade to be executed at a later time at the price we now want. We are not willing to buy that product for 5,000 naira. We want to buy it when it is cheaper at maybe 4,500. That is when we want to buy. We are not interested to buy it at 5,000. It is too expensive for us. So pending order give us the rooms to negotiate prices, give us the room to be able to buy cheap or even sell at an expensive price. So under pending order, we have different categories of trading order. So let's look at them one after the other. We have the buy limit order. Buy limit order is an order to buy below the current market price. Let me just explain all this through. So I will move to the live chart to explain that to you properly. Sell limit is an order to sell above. You don't want to sell at the current market price. When everybody is selling a particular product at 5,000, but you just keep on to your own product, you are not selling it. You want price to you want that particular product to be scarce in the market, and you know when something is scarce, the price tends to go up. So you want when you want to sell when price has gone up, when the value of that product has gone up. That is when you want to sell. You want to sell at an expensive price so that you can make more profit. Buy limit, you want to buy at a lower price, a price that is below the current market price. They are buying it at 5,000. That's the market price, but you don't want to buy at that point. You feel that that price is too expensive and you want to buy at a cheaper price, probably at 4,500. That is buy limit. Sell limit is that you want to sell higher. You want to sell when price is above the current market price. Sell stop. Now you see, both limit order, both buy limit and sell limit, is when you want to when you are trying to buy or sell at cheaper price. This one makes you to have more profit. Buy limit, you want to buy cheap. Sell limit, you want to sell at more expensive price. So the odds is in your favor. Now we are now talking about sell stop. Sell stop is now to sell below the current market price. Now you are not selling at higher price again. The product that you have kept to yourself, thinking that the price is going to go up, the value is going to appreciate, the value just kept on depreciating. Now you are still holding on to it, so you want to sell it just to make small amount of money. You want to have negative profits. You don't want to lose on that product that you have hold. There are some product that has expiring date, and let's say you just hold on to that product, you are not selling it, and you feel that the price is going to be more expensive, but price is just getting cheaper day by day, and you still hold on to it, but you just come to realization that if you still keep holding to this particular product, it's going to expire, and if it expire, it has no use to you again. It means you totally lose on the money you used to purchase that product. So when you now see that the expiration date is already getting near, then you have to sell it at a price that is now lower than what you purchased it. That is sell stop. Selling below the current market price. You are selling at more cheaper price. You now turn it to giveaway price. That is what most vendors will start doing. They will now say, for Valentine promo, come and buy this. It's because their goods is already getting to expiration date. Even sometimes there might not be any festive period. They will just say they are doing so percentage. They just want to sell it off, just to have it away from their stock. That's what most of them do. Is a marketing strategy. Okay, but we are not talking about marketing here. Okay, so now buy stop again. Buy stop is now the opposite of sell stop. You want to buy a product, and you don't want to buy it at that current market price. You are actually willing to buy when price gets cheaper. You want price to come down. Let's say, for example, iPhone 16. Let's say you are a mobile videographer, you use phone, and you feel like the camera for iPhone 16, or let's say Samsung S, the ultra version, let's say you want to get that so that you can have a better videography experience, but the price of that phone is too high, and you feel like you want to buy it, but you want to buy it when the price is cheaper. So you are waiting. You already kept a particular money that, okay, you are going to use this to buy when the price becomes cheaper. But what happened is that the phone just keep increasing in value. Maybe demand for it is low, and the price is still high. The sellers, they don't lower the price, and it's a gadget that you need. So let's say for example it's selling for $1,200, and you feel like, okay, I'm going to buy it when it's dropped down to $1,000, and price of that phone did not drop down, it just keep going up, and now the price is now selling at 1,600, and you already need that tools. You are going to buy it. That means you have buy that gadget at a price that is higher than the current market price. So you are buying at more expensive price not to miss out on that price, because the price may still continue to go higher. So you just have to buy it because it's a gadget that you need. That is buy stop. It is an order to buy above the current market price. So now let me explain that to you on the chart so that you understand that very well. So now on the chart here, now this is the current price that GBP USD is trading at 1.2947. If we want to apply buy limit, let's say we want to buy now, when we are buying, we are expecting that the market should go up, but we don't want to buy here, and we say we want to buy at this point. Okay, let me use this. We want to buy at this point. We want to buy at 1.29270. That is when we want to buy. Buying at this point means that we are buying below. This is where the current market price is. You can see we are buying below the current market price. So this type of order is called buy limit. Buy limit, we want to buy below the current market price. Buy stop is that price fails to come to this low and it just keeps pushing up, and we don't want to still miss out on that. So we are going to now buy at more expensive price, at an higher price that is above the current market price. So we want to buy at 1.29781. That is buy stop. Buying above the current market price, that is buy stop. Buying below the current market price, buy limit. Both, we are still expecting that the price is going to go up. Do you get that? Any question?
No, I understand.
Okay. So now let's talk about the sell stop too. So now for sell limit, sell limit means that we want to sell. When we are selling, we expect the market to go down. So if we want to sell, it means, if we want to use sell limit order, means that we want to sell above the current market price. This price is too cheap for us to start selling. We want to sell when price goes up a bit and then we expect it to go down. This is sell limit. To push up a bit and then we sell, that is sell limit. Sell stop is selling below. That is, if price fails to push up, we want to sell when it gets to this point. When it gets to this point, then pick me and start selling. So this one here below is what? Sell stop. And above is sell limit. Above is sell limit. Okay, you can see how price just jump up. That is because we have fundamentals. We have fundamentals that just came out. So we are still going to talk about fundamental analysis. Okay, so that is sell stop and sell limit. Sell stop and sell limit. Okay, so now let's look at buy stop limit order. Buy stop limit order is an order that comprises of both buy stop and buy limit. It comprises of both of them. You know, buy stop is that we want to buy above, we want to buy above, and buy limit is that we want to buy below. So buy stop limit order is an order that comprises both, setting both together at a time so that you don't miss out on anyone. So that means if price fails to come to buy limit and pick you for a buy, if it fails to come there and price just keep going up, if you get to buy stop, then it should pick you for a buy. That is what you are saying. For buy stop limit order, you are using both at the same time. You don't just only set one. So if you only set one here, we only set buy stop. So we don't only set one, we set both together. That is buy stop limit order. It comprises the both buy stop and the buy limit. And also we have the sell stop limit order. The sell stop limit order is an order that comprises both sell stop and sell limit. Sell limit we want to sell above, and sell stop we want to sell below. So setting both together, and the order that's going to help us to do that is called the sell stop limit order. Do you get that?
Yes.
And lastly, we have the trailing stop. The trailing stop now is a protective order to lock in profit as the market keeps going in our direction. If we speculate that the market should go up, now let me take off this so that you can understand. Let's say we took a buy from this point, and this is our tools that we have used, and we put our stop loss below this point. We put our stop loss below this point, and we have our take profit somewhere around there. And market is already going in our favor. This is our stop loss below this point. So what you want to do when price already moves in your favor, first thing first is to break even. That is by moving your stop loss to your entry point, the point where you enter that trade. What you have just done here is that you have eliminated the risk on that trade. If what you are risking on that trade before is $20, for you to have moved your stop loss to your entry point, it means that there is no risk on that trade anymore. You have been able to eliminate the risk on that trade. That is the first thing you do first. You break even. Now that you have break even and price already move well in our favor, so we want to start trailing our profit. It is still that stop loss we are adjusting, but we've moved it away from stop loss to now trail profit. We are moving it in front of where we have entered our trade. If we should put it here, that means we've been able to secure small profits from this point that we enter our trade to this point that we now have our stop loss. The little profit that is here, we've been able to keep that while we are still on that trade. We did not exit ourselves out from that trade. We are still on it. But we've been able to just manage that trade. This is under trade management. We've locked in small profits while the market is still moving in our favor. So if the market keeps pushing up, and then what we also do from our hand is to keep following it up with our trailing profit. So this way now we've expand more, we've booked more profits. If what we have booked before is just $20, and now that we have shifted it up a bit, it means we have booked additional money to what we have before. So this is what we call trailing. So if the market should not come and reverses, let's see the way it's reversing now, the market now come and reverse and get to where we've put our trailing profit, the market is going to cut us out. But now it's not cutting us out in loss. It's not cutting us out in loss, it will cut us out in profit. In profit. So this is going to cut us out in this profit that we've been able to secure in the market. That is the trailing stop. The trailing stop. So we are still going to get to the practical aspect of this trailing stop, but this one is just to give you an heads up to what you are going to still understand if, when we get to the practical aspects. Okay, let me see what we have next. Okay, what we have next are trading platforms. So we have different trading platforms where you can trade. I know that it is common among traders, we only know of MetaTraders, but trading is not only limited to the MetaTrader application. There are other software that we can also use. We have CTrader, DXTrade, NinjaTrader. We have the Trading View. In fact, there are still some others trading software where we can trade, but the one that most broker uses and that is very common is the MetaTrader application. So we also will be using the MetaTrader application to trade. So if you do not understand how to use the MetaTrader, I will urge you to check the group that you've been added to under our mentorship program. Just check through the link there. It was posted there, I think 2 days ago, or yes, 2 days ago, I think. Yeah, on Monday. It was posted there on Monday. So check the link there to watch how to use the MetaTrader application, because in a very short while now we'll be making use of it. So we'll be using the MetaTrader for executing our trade. If we want to place a buy trade, we want to place a sell trade, we want to trail our profit, we want to trail our stop, we are doing all of that on the MetaTrader application. Okay, and another software we'll be using is the Trading View. The Trading View, we are using the Trading View to analyze. This is where we make use of our technical tools to speculate what we are expecting the market to do, and then we react to that based on how the market is presenting itself to us. So this is the Trading View that I'm showing you. This is the Trading View, Trading View software. This is still the Trading View here. Okay, this is the Trading View. So the Trading View is where we come to use our technical tools to know what the price is going to do next. All right, now do you have any question? We are going to stop here, so we just have to take it
Attention.
we have to take it
Attention.
bit after bit. Okay, so do you have question? Any question?
Yes, go to that the trailing that platform on that trailing. There is something I want to.
Okay,
Uh,
okay, so what's your question
okay,
here?
like the you shifted the stop loss. You trade it up.
Yes.
Okay. And can you? Is it possible to move it exactly closer to the level of the?
Where the market is, right?
Yes.
Now if you want to move it very close to where the market is, you will not be allowed to set it that way, because that your stop loss and where the market is currently, there needs to be at least, I think, minimum of 3 pips or 5 pips away.
Okay.
So you cannot move it so close, and if you move it so close too, that means you are scared of that trade retracing at all. You
Okay.
don't want to give that market room to breathe. You just want to follow it back to back, and if you do that, the market is going to cut you out, and then it keeps on going up. So you want to just give it
Oh,
some gap. It's just as if you want to run and you are giving someone gap. You don't want to stay
Yeah.
closer to that person. When you stay closer to that person, your legs might hit the other person and both of you will fall.
Sure. Sure.
So you want to give that market some space, some gap. We are still going to talk about this more because there are some rules to trailing stop or to trail your profit. There are some things you need to know. Okay.
Oh, all
Any
right.
other question?
No.
All right. If there's no question, we are going to stop our class today and then we pick up from here again on Friday. So have a lovely day ahead, Mr. Moses.
Thank you so much.